Hello everyone, my name is Ujjwal Sharma and today me and my team would be presenting on the topic key metrics in pitching. The first one is gross merchandise value. It is a metric commonly used in the e-commerce industry to measure the total value of merchandise or goods sold through a platform or marketplace over a specific period. GMV represents the aggregate value of all the transactions that occur on the platform irrespective of any discounts, returns or cancellations. It is a measure of the transactional volume and value without accounting for costs, expenses, or profit margins associated with the goods sold. The next one is target group. It refers to the specific group of people or customers that a startup aims to reach, serve, and cater to with its products or services. Identifying the target group is a critical aspect of a startup marketing and business strategy. By defining a well-defined target group, startups can better understand their potential customers' needs, preferences, and pain points. This enables them to tailor their products or services to meet the specific requirements of their target audience and improve their chances of success in the market. The process of identifying the target group involves market research, customer segmentation, and analysis of consumer behavior. The next one is ideal customer profile. Ideal customer profile is a detailed description of the characteristics, traits, and attributes of the perfect or ideal customer for a particular product or service. It helps businesses and marketers identify and understand the type of customer who would derive the most value from their offerings and be most likely to make a purchase. By understanding their ideal customer profile, businesses can better tailor their marketing strategies, product development, and overall approach to attract and retain the most valuable customers. It enables companies to focus their efforts and resources on the audience that is most likely to generate long-term profitability and success.
Total addressable market TAM. Total addressable market or TAM represents the total market demand for a particular product or service. It is the entire revenue opportunity available in a market. If a company were to capture 100% of the demand without any competition or constraint, TAM provides an estimation of the maximum revenue potential for a product or service in that given market. It's a top-down view used especially by startups, investors, and product teams to gauge whether a business opportunity is worth pursuing. So investors use it to decide if a market is big enough to justify investment. Founders and businesses use it to size up opportunities. Product managers and strategists use it for prioritizing efforts. A large TAM suggests high growth potential, while a small TAM might mean you're in a niche or limited market. Serviceable Available Market or SAM. Serviceable Addressable Market represents the segment of TAM that a company can realistically address and serve. It considers the specific subset of the market that a company's business model, resources, and capabilities can effectively reach. SAM takes into account factors such as geographic limitations, customer segments, distribution channels, and the company's competitive positioning. SAM is the portion of the total addressable market that your product or service can actually target based on your business model, geographical reach, legal constraints, and current capabilities. While TAM gives a sense of maximum potential, SAM is more practical. It helps you to set realistic goals based on your current capacity, build a more accurate business plan, prioritize go to market strategies, understand where to expand later. Serviceable Obtainable Market or SOM. Serviceable Obtainable Market represents the portion of SAM that a company can realistically capture or obtain over a specific period. It considers factors such as the company's marketing efforts, sales capabilities, and competitive landscape. SOM provides an estimation of the market share a company can realistically achieve given its market entry and growth strategies. It is the smallest slice of the market triangle, but it is also the most actionable and grounded. So, why is it important? It is important as it helps set realistic revenue targets, crucial for investor pitches. They want to see if you're grounded or not, or just ambitious. It guides early stage growth strategy and shows what's achievable in 1 to 3 years and not decades.
Coming to the average order value. Average order value quantifies the average spending by a customer per transaction, revealing the financial impact of individual customers. So to find out average order value, we have to divide the total revenue by the number of orders. Now calculating average order value is of great significance as it helps us understand the customer behavior by providing insights into customer spending habits and purchasing patterns. It also helps us evaluate business performance by assessing the overall effectiveness of sales and marketing strategies. It also helps in identifying areas for improvement. A low AOV may indicate the need for adjustments to enhance customer engagement and drive more sales. Coming to lifetime value or customer lifetime value. It is a metric that quantifies the total predicted value a customer will generate for a business over the entire duration of the relationship with that business. LTV helps businesses understand the long term revenue potential and profitability associated with acquiring and retaining customers. So, to calculate LTV, we have to multiply average purchase value with purchase frequency and also with customer lifespan. The average purchase value is the average amount of money customer spends during each transaction. Purchase frequency is the average number of times a customer makes a purchase within a specific period. And the customer lifespan is the average length of time a customer continues to engage with the business. Now we'll see what customer acquisition cost is. So basically, it is a metric that quantifies the average cost a business incurs to acquire a new customer. It measures the amount of money a company spends on marketing, sales, and other related activities to attract and convert a prospect into a paying customer. So to calculate customer acquisition cost, we have to divide the total cost of customer acquisition by number of customers acquired. The expenses considered in CAC calculations include the marketing costs. These expenses include the expenses related to advertising, digital marketing campaigns, content creation, social media promotion, search engine marketing, and marketing efforts for acquiring new customers. Next, it includes sales costs. These are expenses associated with sales activities such as sales team salaries, commissions, bonuses, sales tools and software, customer relationship management systems, and any other costs which are directly related to the sales process. Next, it includes onboarding costs. These are the costs incurred during the onboarding and initial setup of new customers, including implementation, training, and customer support. And lastly, it includes the overhead costs. Certain overhead costs that can be attributed to customer acquisition, such as salaries of marketing and sales managers, rent for office space used by marketing and sales teams, and other related expenses may be included.
Gross margin is a financial metric that represents the percentage of revenue remaining after deducting the cost of goods sold (COGS). It measures the profitability of a company's core operations and indicates how efficiently a company is generating profit from its production or sale of goods. Gross margin does not account for other operating expenses such as selling and marketing expenses and administrative costs or taxes. Gross margin provides insights into a company's ability to generate profit from its product or services before considering other operating expenses. High gross margin indicates that a company is generating more revenue relative to its production cost. Greater profit as a larger portion of revenue is retained as a gross profit. The next is business unit economics, BUE. Financial analysis of the profitability and sustainability of a specific business unit or product or service offering within a large company. It involves examining revenue and cost drivers associated with particular unit to understand its financial performance and viability. Analyzing business unit economics is essential for strategic business making, resources allocation, and optimizing the profitability of individual businesses, units, or product lines. It helps identify areas for improvement, cost optimization, opportunities, pricing strategies, and growth potential. Components of business unit economics are revenue generation, cost structure, profitability metrics, customer acquisition cost, lifetime value of a customer, LTV. Burn rate. It refers to a rate at which an organization depletes its cash reserve or funds over a specific period. It represents the net negative cash flow or the amount of money a company spends each month or year to cover its operating expenses. It is a crucial metric for startups and early stage companies, particularly those that have not yet achieved profitability, as it helps assess the sustainability of their financial operations and the runway they have before running out of funds. Factors influencing burn rates are operating expenses, growth strategy, revenue generation, funding round. We can also see the place at which a new company not yet generating profit consumes its cash reserves. High rate burn rate indicates that a company is spending money at a rapid pace and depleting its cash reserves quickly.
Burn multiple. Burn multiple is a capital efficiency metric. It compares how much annual recurring revenue is added with how much cash is spent. Burn multiple is equal to net burn by net revenue. A high burn multiple means that the company is burning cash at a rapid rate compared to how much it is growing its revenue. This might indicate inefficiency or that the company is scaling too aggressively without generating enough revenue. On the other hand, a low burn multiple means the company is more efficiently using its cash to generate revenue. Why is burn multiple important? Companies with high burn rates that never turned a profit received plenty of funding until recently. Uber, WeWork, and Klarna, who financed their growth with additional rounds of funding. VCs were happy to bet on companies with high burn multiples in the days of growth at any cost.
Now, moving forward to cash runway. Runway refers to the amount of time a company can continue operations before it runs out of cash, assuming its current burn rate remains unchanged. It is a critical metric for startup and businesses that rely on external funding. Runway equals to cash current balance upon net burn per month. Why runway is important? Fundraising planning. Startup need to secure additional funding before their runway runs out. Expenses control. A short runway signals that the need of cost cutting or efficiency improvement. Business growth strategy. A longer runway provides more time to experiment and scale the business without immediate pressure. How to exceed runway. Reduce burn rate, cut unnecessary expenses, negotiate contracts or optimize operations, increase revenue, improve sales, introduce new revenue streams, or optimize profits, raise more funds, secure investment from venture capitalists, banks, or grants. Churn rate. Churn rate is the percentage of customers who stop using a product, cancel a subscription, or discontinue a service over a specific period. It is a key metric for a business, especially SaaS and subscription based model, as it directly impacts revenue and growth. Why churn rate is important? Measuring customer retention. A high churn rate indicates poor customer retention leading to revenue loss, affects growth. Even if a company acquires new customer, high churn rate slows overall business growth. signal products and service issue. Rising churn rate may indicate dissatisfaction, price issue, or strong competition. Impact profitability. Retaining existing customer is cheaper than acquiring new ones. Investors' confidence. Low churn rates signify stability and long-term revenue potential, making the business more attractive to the investors. SaaS and subscription business less than 5% per month is considered as good. B2B lower 1 or 2% is idle due to long-term contracts. MRR monthly recurring revenue. MRR is a prediction or recurring revenue a business earns every month from subscription-based service. It is a key metric for SaaS, streaming, and other subscription-based business, providing insights into financial stability and growth trend. Type of MRR: New MRR, revenue from new customers; expansion MRR, revenue from upgrades, add-ons, or upsells; churned MRR, revenue lost due to customer cancellation; net MRR, total MRR after expansion MRR and subtracting churned MRR. Why is MRR important? Predictable revenues helps business to forecast future earnings. Growth measurements show whether a business is scaling effectively. Investors and valuation metrics. A high and increasing MRR makes a company attractive to investors. Strategic decision making helps in budgeting, hiring, and expansion planning. Gross MRR churn. Gross MRR churn is the percentage of total monthly recurring revenue lost due to customer downgrades and cancellation in a given period without considering any revenue gain from a customer or expansion. Why is gross MRR churn important? Measuring revenue loss show how much revenue is at risk due to customer churn. Indicate customer retention issues. A high churn rate signals dissatisfaction or pricing concerns. Helps in forecasting and decision making. Business use these metrics to adjust pricing, improve customer experience, or focus on retention. Ideal gross MRR churn rate less than 5% per month is considered as good for SaaS and subscription business. Less than 10% per month is a warming sign requiring immediate attention to customer retention strategies.
The next one is annual recurring revenue. It is the total predictable revenue a company expects to earn annually from a subscription-based services. It is a crucial metric for SaaS and subscription businesses, helping measure growth, financial stability, and long-term revenue potential. Revenue predictability ensures stable recurring income for long-term planning. Business valuation used by investors and stakeholders to assess financial health. The next one is annual TPV. The growth of annual total payment volume is quite a remarkable one, taking place in tandem with the expansion of the market and rising transactional activity. The observed performance is driven by some of the following key factors. The first one is strong growth trend, rising transaction volumes, larger ticket sizes, market expansion, strategic partnerships, and seasonality. The next one is organic digital marketing. It can take time to build trust with people and credibility for a business, not because bursts of income from short term promotions are nasty, but because they don't yield lasting results. Organic digital marketing makes itself long term much easier. The next one is revenue drivers. The growth in revenue occurs through multiple levers that result in either greater sales or improved retention of existing customers or penetration of new markets. Such key levers of growth, for example, are customer acquisition, price strategy capture, upselling and cross-selling, retaining customers, market expansion adopting, and product diversification. The next one is Pre-money valuation. Pre-money valuation calculates the worthiness of a firm prior to receiving any external funds, which ultimately influences how much equity the investor owns and the structure of the deal. The major factors considered for establishing a valuation include the revenue and growth trajectory, market opportunity, customer base and retention, business model and scalability, intellectual property and technology, founding team and execution capability. The next one is post-money valuation. Valuation post-money indicates the worth of a company after the consideration of external investments that are determined by equity for the investor and future fundraising potential. That is measured as follows. Post-money valuation equal to pre-money valuation plus new investment. The main aspects will include investment amount, equity dilution, growth rates, market positioning, operational expansion, and investor confidence. Thank you.